for those of us that are looking to expand our credit card portfolios for consumer or small business. And I'm going to give you a handful of reasons why. But I believe 2025, 2026 can turn out to be a really big year. A lot of people may think that the big banks are the ones that control a lot of commercial lending. They don't have a lot of high exposure. The first thing that I think is going to change, interest rates will continue to come down. That's something that President Trump wants to see happen. And honestly, a lot of people think is the next major bubble that could pop in the next year or two, creating a real cascading default of a lot of commercial properties, everything from office to apartment complexes, et cetera, et cetera, et cetera. So I have a real focus point on expanding my access to financial resources, increasing my network going into 2025 and beyond. One of the ways of doing that is knowing the financial institutions that are going to provide the best opportunities and in the best shape themselves to meet my needs, whether that's going to be lending needs, deposit needs, investment needs, etc. Knowing which institutions are going to be the ones to go to for your various financial needs as you're growing your financial position is essential. I'm going to let you know why I believe not only American Express, but a few other financial institutions are going to be great to go to, particularly around credit cards and other lending needs, but credit cards in particular going into 2025 and going into 2026. So at the time of this recording, it's early 2025. The context I'm about to give you is really more for towards the end of the year and going into 2026 because it takes time for some of the factors I'm about to explain to kick in and to actually roll out into underwriting into the overall business model and functionality of these different financial institutions. But I believe the back half of 2025, 2026 can turn out to be a really big year for those of us that are looking to expand our credit card portfolios for consumer or small business. And I'm going to give you a handful of reasons why. The landscape that has decorated the 2020s as a whole has been a rocky one, and it's led to what we've experienced the last 2 years or so of 2023 and 2024, now that it's complete, being a really tight year for underwriting and overall lending, as well as overall defaults for consumer debts and small business debts, as well as financial institutions that have been in serious trouble in the last couple years or so. We know COVID hit in 2020, and that's paved the way for the entire decade of the 2020s in fiscal policy, spending, Federal Reserve rate changes, and the way banks have functioned the last few years has changed dramatically from what we came from in the 2010s. Underwriting has been affected greatly by this. Consumer credit card debt has spiked over $1 trillion at the time of this recording since the 2020s, as well as a lot of commercial real estate debt has come into a tight spot, putting financial institutions that are the biggest lenders in commercial real estate, which is small and regional financial institutions, believe it or not. A lot of people may think that the big banks are the ones that control a lot of commercial lending. They don't have a lot of high exposure. It's your mom and pop local, community, and regional and super regional banks that do a lot of the commercial lending. And they've been in a very tight spot. Hence, interest rate changes and commercial lending strains like your bank collapses we had in 2023 that have already swept under the rug, but a lot of that strain has not changed. And this is where credit card lending has changed a lot. Banks have been a lot leerier. Underwriting has been tighter. The checks and balances and cross-referencing on credit card applicant, meaning that they want to know more about you, verifying your identity, and your income has changed and spiked a lot in the last 2 years or so. And denials have increased significantly by financial institutions. Some of our favorites like Navy Federal, some of these super regional banks that we've really, credit unions and super regional community banks that we've grown to love in the 2010s and the really early 2020s that were giving out high limits and approvals like water, have dried up or gotten really, really conservative in their underwriting. If you've been in a good place, you've continued to get access to financial resources. You've continued to get high credit limits and approvals without a hell of a lot of strain. But if you've been anywhere in that shaky area where your okay credit scores, 660, 680, maybe that early 700 range, your DTI has been a little tighter in a leery place, at the end of the day, you have probably experienced rougher underwriting. And I think that's going to change, and I'm going to give you the landscape why. The first thing that I think is going to change, interest rates will continue to come down. It may be a hell of a lot slower, but they will continue to come down. That's something that President Trump wants to see happen. That's also going to be something that the Federal Reserve is already projecting to happen. And that's likely going to stay consistent. It just may slow down because there's a lot of uncertainty because President Trump's putting so many policies in place that are going to be potentially inflationary, but there's just a lot of uncertainty on how they're going to play out. The Federal Reserve doesn't want to be too much more preemptive on pulling rates down, and they find out that the policies that are being put into place and signed into law are going to force them to reverse course. So they're just trying to slow down and be observant. But their SEP, which is their Summary of Economic Projections, already projects interest rate cuts for the next couple of few years. It may be slower, there, but they're coming. That and the fact that President Trump is advocating for them means that they, even though these two act like they're at odds, they really have a common objective for the economy overall when it comes to interest rate and the Fed's funds rate. That is going to take a lot of pressure off of large, medium, super regional, community, and credit unions in their underwriting. The reason for that is twofold. For one, it directly allows them to lower their rates, make more, and have a better spread on what they're able to earn on their lending, which is going to increase revenues, allow more money to flow into the system, because when interest rates are cheaper, mind you, the Fed's funds rate is what banks are paying to get access to money to put out into the marketplace, okay? So at the end of the day, that means money is going to be more accessible for them. The next thing that is going to do is take pressure off of like commercial lending, which is in a real quagmire right now. And honestly, a lot of people think it's the next major bubble that could pop in the next year or two, creating a real cascading default of a lot of commercial properties, everything from office to apartment complexes, et cetera, et cetera, et cetera, various different sectors of the commercial space. If rates do finally start to actually come down, that will take pressure off commercial lending and could salvage or at least reduce the pressure off of a lot of local community and regional banks that are under strain right now, because that part of their books is heavily exposed and those commercial loans are in a bad spot. So if that starts to change in the next year and a half, 6 months to year and a half, it could allow them to open up lending in other parts of their books like credit cards. Hopefully you're sticking through so far. The next reason that I think things are going to get better is because Trump plans to reduce regulations on financial institutions. That is going to lead to them being able to do business more frequently, faster, and increase profits. That's going to allow them to lend more as well. That's going to also probably allow them to get a little bit more lenient in their underwriting. So rates coming down, the economy opening up more, domestic production increasing more, and regulations coming down. If that all comes into play and can come down without a lot of hiccups or hurdles to him passing these different policies, I think that this will lead to a significant opening up of underwriting. I'm not sure if it's going to flow like it did during COVID and prior to COVID, where people were getting approvals like crazy and high limits like crazy. But the tightening we've experienced in 2023 and 2024 and the earlier part of 2025, I think will start to relax. The last reason I think that there's going to be a significant increase in lending and credit card lending is going to open up and become more favorable in the near future is because Trump plans to have massive tax cuts, not only to consumers, everyday working class, the rich, but to corporations. So on top of reducing regulations for these financial institutions, they can also experience a noticeable tax cut in the near future. This is going to increase their bottom line as well. And as long as they're healthy and their books are starting to get healthier and more revenues passing for them and their bottom lines are increasing and the regulations are lightening up, they're going to lend more because that's more potential for them. And they will get a little bit more lenient on underwriting because there's more money flowing through the system, more money flowing on their books, and tax cuts for the working class, especially if some of those like no tax on tips, no tax on overtime kicks in. That kind of stuff can lead to increased incomes, increased bottom lines for their applicants. That can turn around and show up major for underwriting as well. People's DTIs can get in a better place because they're taking home more money. Hopefully, if they're smart, they're paying down debt and they're showing more money on their individual books as individuals and applicants. They can put more down on their applications. So all of that's going to lead to an opening up, or could lead to an opening up in the credit card market. And I think this is something that the top 20 big banks are really going to benefit from. A lot of these things are going to be hard for local, community, and regional banks to unwind. That commercial strain is a real problem. Interest rates are going to come down slower, so they're going to see reprieve on a slower basis. But these big banks that are already in a good position, that are not overly exposed to the strain markers of commercial real estate, that have already been tighter on underwriting in the past. So the people that are defaulting on their books are less because they weren't lenient on underwriting in the first place. Your big banks, okay, your top 20s. That's going to make places like American Express, Chase Bank, Bank of America potentially, Goldman Sachs, some of these larger financial institutions that are seeing record earnings, going to see less regulations, going to see tax cuts, going to see more incentives to do business and more incentive to lend. This is going to lead to those top 20 being the first to be more lenient and broader on their underwriting on consumer and small businesses going forward. That is my prediction and my assessment going into 2025, the back half of 2025 and going into 2026. That are my major top 4 or 5 reasons why I think these things are going to open up. Comment down below and let me know your favorite top 20 financial institutions. I'm going to have a list somewhere on the screen of who they are. Let me know who your favorites are, who you have great banking relationships and credit relationships with already, who you're looking to expand your credit card portfolio with out of that top 20 to 25 list. And I want you to comment down below and let me know what you think of the overall assessment I gave. If you agree or you think that there's more cause for concern where underwriting will stay tight, comment it down below and let me know why. To all my pioneers, welcome back. To my new viewers, welcome in. As always, I want each and every one of you to stay focused, stay in motion. I'll see y'all soon. This is my blueprint for financial empowerment and self-sufficiency. This is my blueprint for optimal health and body mastery. This is my blueprint for mental, physical, and spiritual momentum. This is my blueprint for prosperity.